Hello there, and hope you all had a good Christmas and are looking forward to New Year. My name is Michael Hewson, and welcome to this Good Money podcast with me and Michael Brown from Pepperstone, Senior Financial Market Strategist, where we look back at the performance of the FTSE 100 as well as the performance of the pound over the last 12 months and maybe have a little look at a sneak preview as to what may be coming down the line in 2025. First and foremost, I'd like to thank our sponsors, our sponsors, Pepperstone. There's me getting my alliteration really mixed
Someone's
up.
been on the sherry over Christmas.
Yeah, I think so, mate. Who are a multi-regulated CFD broker providing trading services in forex stocks and commodities in multiple destinations. Well, that was embarrassing. I hope your head of sales, Lawrence, can forgive me for that. Maybe I should have had a little less gin, or a little bit less sherry, shall we say, in the aftermath of my mince pies. Anyway, welcome, Michael.
Hello, mate. How you doing? Merry Christmas to you and to all our listeners as well. Hopefully enjoying the festive period and getting a chance to rest as well. It's been a very, very long 2024, and I think we all need the rest a little bit more than usual over Christmas this year.
Yeah, certainly I think probably maybe longer for you than me, Michael, given the fact that I spent most of the summer and the autumn off in a sort of an enforced absence, if you like. But I decided to get a little bit Christmassy with the jumper. You have to show our listeners and, well, not show our listeners, show our viewers what you got as a Secret Santa present.
Well, I've thrown it over the other side of the room, so I can't go and get it now. But okay. Clearly, I didn't get the memo about wearing a Christmas jumper on this podcast. But I do have a black bar humbug Santa hat, which I may pull out later on, or perhaps with some clever editing we can squeeze into the video somehow.
Sounds good. Well, I suppose before we get underway, I'd better do the disclaimer, which I nearly forgot earlier this month, and which you dutifully reminded me of my responsibilities. So here we go. The information provided here, whether from a third party or not, isn't to be considered as a recommendation or an offer to buy or sell. It's also not a solicitation of an offer to buy or sell any security, financial product or instrument, or to participate in any particular trading strategy. We advise any readers, viewers or listeners of this content to seek their own advice. Spread bets and CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. 75.1% of retail investor accounts lose money when trading spread bets and CFDs with this provider.
It's a very serious message, that, but I'm struggling to take you seriously in that jumper.
Oh, for I know. Maybe I might have to lose the jumper, I think. But you got to get into the spirit of things. We've just had a fairly decent Christmas, and essentially I think we're probably now sort of whiling away the days until New Year's Eve and New Year's Day, and then we get back on the treadmill again. But
yes, indeed.
Before we do that, I thought
let's not wish time away.
Absolutely. But I think it's always instructive when looking towards the future, if you have a look at what's sort of gone on in the past. And I know you criticised me heavily about my use of technical analysis, but for me, it's at the cornerstone of everything that I do. And it's very easy to sort of take the mickey, and I know it's good-natured. But for me, I think looking at a chart, and as long as you keep it simple, and I think that's the key thing here, keep it simple, then ultimately it's essentially almost like a roadmap towards potentially what might happen. And I think you have to use it when you're talking about risk management. So I think for me, when we look back at the FTSE 100 and we look back at the pound and interlink that with what bond yields are doing, then perhaps we'll get a good idea of what might be coming down the pipe in 2025.
Have you had your crayons out again?
I have had my crayons out again, and there's a really there's a couple of really, well, I would say decent articles. There's a couple of articles, and I generally I did this every year when I was at CMC.
He's being far too modest there. I've read the articles. They're very, very good articles, very insightful articles that you've written for the Good Money Guide website.
And this is something that I did every year when I was at CMC, and I intend to carry on doing it because I think for me it's also a good way for me to refresh my memory as to what's taken place over the course of the past 12 months. And ultimately, I think it also gives a good insight as to what central banks also might do later in the year when it comes to potentially cutting rates further. So let's start with the FTSE. It's underperformed again. And this is not a new thing for the FTSE 100. And earlier this month, the FT published an article which said that 88 companies. It's not been a good year for the London market, has it? 88 companies delisted or transferred their listing this year.
It's been an utterly grim year for the London market. I mean, I think, as you said, FTSE underperforming is nothing new. We could have filmed this in 2023 or 2022 or 2021. I mean, that is a long running trend. I think what's becoming more concerning now is the fact that not only do we have in the UK a benchmark equity index that is clearly lagging behind its peers, and there's a number of reasons for that. But it's also the fact that actually there are now quite deep-rooted structural issues with the London market itself in terms of liquidity and in terms of the unattractiveness of that market, particularly to growth and tech-focused companies. And no one seems to be getting a grip on that. And that's something that is only going to get worse and worse. You mentioned the FT article. I think this is the biggest exodus from the London market since the financial crisis, all the way back in 2008, 2009. Also, you mentioned to me very recently, and I think this is via Bloomberg, that London is now 20th on the list of capital raising markets for the activity that's taken place in 2024. And correct me if I'm wrong, I think is it $1 billion that's been raised this year, which, I appreciate that sounds...
$1 billion, exactly. Not £1 billion, $1 billion.
No, that sounds like a big amount, but that's actually less than markets in the Middle East, like Oman, for example,
which is 1/20th of the size of the London market.
Exactly, and by no means am I sort of sitting here saying London's got a God-given right to be the centre of the financial universe, but it is a worrying situation for the London market and for the FTSE. I guess the question in 2025 is how many more run away and move their listing to the States or anywhere else.
Yeah, I think that's the worry, isn't it? I mean, because when we look at companies like Ashtead, we look at companies like Flutter Entertainment, CRH, Darktrace was taken. I remember covering the IPO of Darktrace, and I was really excited about the prospects for that particular company, and now it's gone. And that would have been, that's the ideal tech company that you want to attract to the London market, and we can't even hang on to that. It was the same with Arm Holdings all those years ago.
I was just going to say Arm Holdings. You then think about the ones that sort of aren't in the figures because they never actually came to London in the first place. Arm Holdings took one look at London and supposedly considered it, and then went, actually no, we're going to go and list in New York. So I think this is a real issue. And of course the other problem for the FTSE, and this is a very long-standing hurdle for the index, is it's an old economy index, to coin a term. It's banking and mining stocks fundamentally, and a bit of oil and gas thrown into the mix as well. And when you've got a market environment where everything is about tech, everything is about AI, everything is about growth stocks, the FTSE is always going to struggle in that sort of a landscape.
Which is a pity, but I think that also speaks, I think, to the regulatory environment here in London. Not just the regulatory environment, but also the tax environment. And I think the biggest concern, and I think we talked about this recently, is that unless the government does something to make the UK market more attractive, then we could see bigger companies leave the FTSE. Shell earlier this year talked about the prospect of moving their listing, because initially they had two. They had one in Holland, and they had one here, and they decided to just basically make their primary listing here in the UK. But it's interesting that the CEO, Mr. Sarwan, didn't rule out revisiting the topic of moving its listing if circumstances changed. Well, circumstances have changed quite a bit since the early part of this year.
Yes, absolutely. And, I don't want this to become a political broadcast, but we do now have a government that is, I would say, anti-business and certainly anti-energy, the focus on green and renewables. But I guess the question I would say to you is, that's a lot of doom and gloom. There are a few bright spots out there, aren't there?
Absolutely. I mean, when I looked at the FTSE to see what did well, you talked about the banks, and I'm looking at my graph here, and we've got the likes of NatWest and Barclays that are both up over 75% year to date. So, shareholders in those businesses have done very, very well. And, both of those companies, both of those banks are also paying a dividend. And then you've got Standard Chartered in fourth place. So HSBC and Lloyds have actually underperformed. And I'm going to talk a little bit about Lloyds when we talk about the bank. So we're not going to cover that here. But, there was a couple of other really, I think, what I would call mark brands, which a few years ago everyone was dumping on from a great height. They've done really well for the second year in a row. And I know
Do share
Rolls-Royce, Rolls-Royce and Marks and Spencers. And I've written about that in the winners and losers of 2024. Rolls-Royce has been a remarkable turnaround story. I can remember when it fell to as low as around about 80p in the aftermath of COVID, essentially because all of their maintenance agreement for aircraft engines, well, they just stopped. Their income, their cash flow just stopped overnight because of COVID, and they really struggled to stay alive. And I remember having a bit of I think it was a social media row with someone. That basically
surely
said,
not.
Surely not. Well, that's all that ever happens on social media.
Well, that's very true.
Saying that Rolls-Royce was a basket case and he wouldn't touch it with a barge pole. And I thought to myself, well, hang on a minute. Just because, it's struggling to stay afloat now, as long as it can keep going, the planes aren't going to stay on the ground forever. But one of the things it does need to do is diversify its business model. And it's certainly done that. I mean, the new CEO came in. He called it a burning platform. That was one of the first things he said about it, which as a shareholder, and, for full disclosure, I do have some shares in Rolls-Royce. I thought to myself, what are you playing at? But, when you look at what Rolls-Royce has done now, they're talking about potentially the sky's the limit. Not only are its aircraft large engine flying hours now at 109% of 29 levels, and it's 2019. It's taken 5 years to get there, mind you. But it's also got really decent defence contracts. The engines for the new B-52 Stratofortress out of the US, and it's got these new nuclear reactors, which our governments seem remarkably reluctant to sort of take a punt on.
Yeah, indeed, that one is surprising. And Rolls-Royce are actually one of the few UK listed companies who you would say are being genuinely innovative. I mean, in terms of their performance, it's been staggering. There was one point this year where actually, since the start of 2023, Rolls-Royce had outperformed Nvidia on both a sterling and a dollar basis. And, you think about the headlines that Nvidia has attracted.
I didn't know that.
Comparatively, Rolls-Royce has gone under the radar. I would say, though, and you're right to flag that quote from the CEO when he took over. Very, very stark indeed. But that's nowhere near the winner of my Chief Executive Quote of the Year award, which I've just come up with to return to the banks. And this is, of course, Standard Chartered's Bill Winters, who in February made the PR profession cringe by saying our stock price is crap, and that's a direct quote. He then upgraded his assessment of the stock price in the July earnings report by saying our share price is now, quote, less crap than it was. Now, I think both of us can get behind that level of directness from company management, and I think I'd be glad to see other leaders follow in 2025.
Well, fair play to him. The share price is up more than 50% year to date. So he was obviously correct in his assessment of the bank's performance, or underperformance,
absolutely,
if you like. So, sometimes a bit of plain speaking on the part of CEOs is welcome. And, as long as they don't tank the share price, then for me, more power to his elbow, I would say. Anyway, also there was Marks and Spencers. That was another big winner. It's carried on with its turnaround story. 5.7% increase in statutory revenue in the first half of this year to £6.48 billion. And once again, it's food that's driving it. But also, general merchandising, clothing, is also contributing to the bottom line. And, I've covered Marks and Spencers since 2008. And it's only in the last 5 years that we've really started to, for the umpteenth turnaround story, we're now starting to see the company, pay dividends essentially and start to deliver on their turnaround strategies. And to my mind, it's welcome because, there's nothing more British than Marks and Spencers or Marks and Sparks or whatever you want to call it.
No, absolutely. They are a stalwart of the high street. I guess, what do you think is different about this turnaround plan? Because as you say, I've lost count of the number of turnaround plans they've put into place over the last decade or so. But what is it this time that's actually working for them, do you think?
Well, I think they've taken control of their own supply chain. So ultimately, every single part of the business is now within their control. When you compare the, say, performance of Marks and Spencers and you look at the retail sector as a whole, only Next has got close to how well they performed this year. Next is in positive territory for this year. It's up around 20%. Marks is up 40%. And for me, I think sometimes you can be down on a stock for so long that sometimes people just forget that actually underneath that, there is actually a fairly decent business. The problem is getting enough people to believe that. Now enough people do. They're taking steps to revamp, the real estate, the store real estate, basically get rid of the stores that aren't performing and upgrade the ones that are. And I think they're also focusing much more on food, which they've always done very well at, and essentially creating food-only stores. And they're starting to take the fight to that sort of middle Waitrose end of the market and essentially cornering it. The bigger concern that I have going forward is that how much more upside is there? But, they're growing both sides of the business fairly well.
Yeah, exactly. And I think you're absolutely right. And as long as they can continue to do that, then you would expect that those gains are likely to continue. Certainly, speaking anecdotally, every time I go in an M&S, and I appreciate that the square mile is not the entirety of the UK, but it looks like business is doing very, very well indeed for them, judging by how busy they are.
Absolutely. I mean, they shut down one of their city stores, and I think that was a problem. I think they had too many stores in certain locations, and they've just basically condensed that down into a much more efficient operation. I just want to leave this particular part of the FTSE 100 and the components thereof with this here. I don't know whether you can see that.
Oh my word! What's he got?
Basically,
here?
That's the performance of stock markets over the course of the past since 2020, and the black line, which is the bottom line, is the FTSE. So you can see how much it's underperformed relative to indexes like the DAX, the S&P 500, and the Nasdaq 100.
And is that in which currency have you done that in?
I've just done that in basically I've just done a straightforward overlay.
Just in the index currency.
Just on the index currency. So it's not in currency terms.
To be honest, no matter what currency you put it in, you're going to end up with the FTSE being that Indeed. Bottom black line, aren't you? So
you are. So I think we'll basically condense this particular part of the discussion with respect to the index. We've looked at the components. We've looked at what's done well. Do you think that we can, even though we're seeing the DAX, the S&P and the Nasdaq making record highs this month, the FTSE 100 continues to tread water, and I think that's something that it continues to do. It breaks to a new high. We think it's going to kick on. And then suddenly it range trades. And it's been range trading 8,400, 8,000 pretty much since April. Can we see a move towards 9,000 next year? Or are we going to essentially see 8,000, 8,400 for maybe the first part of next year? Can you see a new record high? Is it in essence what I'm trying to ask?
I mean, I wouldn't be surprised if we did see another record. I think 9,000 is probably a little bit of a stretch. I think really, the balance of risks points towards a kind of continuation of exactly what you've just described, where we try and break out of the range. Maybe we print a new record high, and then we just settle down and plod along and move sideways once more. All of the issues that have plagued the market and that we discussed at length earlier on, they're certainly not going to be solved overnight, and I don't see any desire from anyone to be solving those in 2025. So actually, and I think that's going to contribute to continued underperformance in the FTSE. And if we get one of these big names like a Shell leaving the index, then that's only going to make things even worse.
Yeah, I think that's the worry going forward. But on a more optimistic note, I can't see anything significant, barring a black swan event, an unexpected event, that's going to derail the current move that we're seeing, or the current optimism that I think, if you like, when it comes to further market gains in 2025. I think the one thing that could derail that is perhaps, as I said, a black swan event or central banks. So let's move on to currencies, because I think one thing we can agree on is the next move in interest rates, is going to be a cut from the Bank of England, perhaps obviously as soon as February. The pound has actually done fairly well this year, almost on a par with the performance of the dollar. Now that's not because the pound's particularly strong, though, is it?
No, it's primarily, and this is the beauty of the foreign exchange market. Of course, you are dealing with a two-sided equation. It's not just the equities where you are judging that stock or that index on its own merits. Of course, when you buy one currency, you have to sell another. And I think you look around the G10FX landscape over the last 12 months or so, sterling's outperformance is almost by default, because it's just been slightly less of a basket case than economies elsewhere. You look at what's happened in the Eurozone with the various political issues in Germany and in France, and of course the manufacturing depression, which it effectively is at this point. You've also had very, very aggressive rate cuts coming through elsewhere. Places like New Zealand, Switzerland have cut rates pretty aggressively. Canada have cut rates pretty aggressively as well. And then the Bank of Japan, they just haven't lived up to expectations in terms of rate hikes, and that's obviously punished the Japanese yen. So sterling has held relatively firm against the dollar, and we're ending the year pretty much where we started it, as near as makes no difference. But the reason for that is by no means any extreme bullishness towards the UK economy, I don't think.
Yeah, I've always characterised it, particularly when it's the euro against the pound, as the choice between two drunks at a bar. Which one do you go home with?
God, what an analogy that is.
But it is essentially that. And I think one of the things that I think 2024, when we were looking ahead to 2024 at the end of last year, it was the timing of the first rate cuts. And I remember there was an awful lot of bets, and I think I had a little bit of we had a little bit of a toing and froing. People were talking about a March rate cut from the Federal Reserve, and I dismissed that out of hand. I just said that I couldn't see it. And that I thought the ECB would potentially cut first in April. They didn't. I was off timing-wise, but certainly they were the first to start cutting in June. And I think of all the big four central banks, they've probably been the most aggressive, without, I think, really affecting the euro that much, apart from obviously weakening it towards the low. I think it was a low of about 103.10. Do you think
just above the
parity?
103 figure. I don't. And then speaking of little wagers, I have a sort of charity wager going on that one that I believe, and I don't think we'll see this next year, but I think we will probably print 110 before we print parity, purely because we won't get as low as parity. Just going back to your point around market pricing, remember where we were at the start of 2024. We came into the year thinking that the BOE and the Fed would both cut 6 times in 2024. We're coming out of the year.
I didn't think that.
Well, that's what market pricing was implying.
Yeah, that's what market. But obviously, you don't have to agree with the way the market's pricing it.
Of course,
the market was saying the Fed would cut in March, and they didn't. So,
but we're then coming out of the year, and the Fed have cut 3 times, but 100 basis points in total. But the BOE have only cut twice. So the market was, massively mispriced in terms of being overly dovish at the start of 2024, my sort of thinking now, particularly in terms of the UK, is the market now mispriced in the other direction and is actually priced too hawkishly for what we might get in 2025?
Well, we're certainly seeing that played out in what bond markets are doing, yields are doing. I mean, because I was just looking at what the UK 5-year is doing just now, and for me, I mean, obviously they had the budget, yields went up as a consequence of the budget, and 5-year yields went up, I think, as high as around about 4.5%. Soon after that, we saw them dip back to around about 4, but they're now around about 4.35. So the market is a little bit concerned, I think, that the next move, well, I think it's not about whether or not we'll see more rate cuts. It's whether we see as many as perhaps the market thinks.
Yeah, and the other thing that's really interesting, and this is true if you look at gilts or if you look at swaps, is that the BOE have actually cut rates by 50 basis points in August, since August. But actually, you've seen gilt yields move higher and you've seen swap rates move higher. So actually, the transmission of those rate cuts, i.e. what people are feeling, is nowhere near as much as you would expect it to have been, because the BOE have lowered rates. But actually, if you were to say remortgage or get a mortgage now, it would be considerably more expensive than it would have been if you were trying to do so at the start of September, even though the BOE have cut rates over that period. And that's just an interesting dynamic where, as you say, the market is casting a little bit of doubt and viewing things a little bit more dubiously than policymakers would probably want.
But that makes perfect sense to me, because ultimately in September, the markets was pricing in a lot more rate cuts towards the end of 2025 and 2026 than they are now. And essentially the yield curve has a tail. And and what's happening is, if you're starting to price out rate cuts at the 2 or 3 years out, then that's going to tighten it up slightly more forward. And that's why you're going to get, despite a 50 basis point rate cut, because you're pricing out rate cuts further out, the yield is going to go up. Hopefully that makes sense.
Do you know what? It does. I don't know whether that says more about me or about you, but it does make some degree of sense. I guess the question then is so sterling.
So for sterling, I mean, in terms, are we going to get back to 120, 115, or are we going to go back to 130? I mean, because I think when I look at my chart, it doesn't look particularly sterling positive right now.
Well, I'm glad you've said that, because I was going to say I'd say 120 before 130, and we're trading about in the middle of that range now. But yeah, I would say we trade 120 before 130 for two reasons. One, I think the market is a little bit too optimistic in terms of the UK economic outlook going into next year, and the second being that I think the dollar will continue to trade relatively well, particularly in the early part of 2025. You're probably going to have a relatively hawkish Fed. You're going to have a bit of a growth kind of sugar rush going on as Trump brings in tax cuts and a whole host of other fiscal stimulus. And at the same time, you're going to have tariffs being imposed on the US's trading partners, which will probably strengthen the dollar by default. So I think some further downside could be in store for the quid.
In that case, why don't you see the euro at parity?
Because I don't think we fall that far. I think the euro gets to a point of peak pessimism before the pound does.
Right. So we're about 10. Where are we? Euro dollar around about 105,
about 105, aren't we?
Yeah, 105, 106. So 500 points euro, fall to parity, and yet we could get to 120 in cable. So that's assuming euro sterling doesn't go anywhere.
Yes.
So, for me, you think 130 before 120, but 110 before 103. I'm trying to square that circle and I can't. But, that's what makes a market, right?
Exactly. Let's sit here in 12 months' time and
we don't even have to do it then. We can probably do it next month or 3 months' time or what have you.
That's very true.
But for me, in terms of the technicals, we hit 134 in the pound in September. We then dropped all the way to 124. There was a lower peak after that, and there's a lower peak after that. And at the moment, we're struggling to get through 128. For me, I think 128 is the big level on the pound. If we can get through there, then I certainly think that we can go on to 130, but that's a huge barrier because it's 50-day moving average, 200-day moving average. Momentum is not in the pound's favour at the moment. It's been declining steadily since September, so we need something to break that cycle and turn it round. Because for me, markets are about momentum. They'll go in a particular direction until you get a catalyst to turn it round. And at the moment, I don't see that catalyst. And if we break 124, which was the lows back in November, that could be the catalyst for a move to 120. So 124, 128 is where we are in the pound against the dollar.
Well, there we go. A very concise overview of the state of play, mate.
And euro sterling is still in a downtrend, and the big level on euro sterling is 0.8250. So if we break below 82.50, then we could see a move back to 80, 0.8.
And we have tested that level quite a lot over the last couple of months, haven't we, actually?
We have, yeah. I mean, the market's had about 3 or 4 goes at it, but every time it's got there, the rally has been lower. And that suggests to me that the sellers aren't waiting for the bounce in the same way that they were previously, and that tells me that momentum is building up for a push lower. And again, it's the momentum thing. You look at what the reaction is of previous highs and lows, and you look for evidence of a significant rebound. And if you don't get it, then ultimately you trade with that. And that's why I use my crayons. That's what they're for. Right, to paint a picture. Now, obviously, if we get back above 84, 0.84 in euro sterling, that breaks the downtrend, and then we go again. Maybe go back to 86. But for me, the clear momentum for euro sterling is a lower euro and a stronger pound.
Well, only time will tell if Mr. H's crayons prove correct once again.
Who knows? Anyway, that's it for this little Christmas New Year interlude, looking at the FTSE, looking at the pound. So I think in summing up, what we can say is that we remain broadly optimistic on stock markets. FTSE 100, if we can retest that 84.74, then I think there's certainly a good chance we can go through 8,500. I think for me, a clear break is going to be 8,500. It's a nice round number. If we can get through that, then I think we could go for another trip towards the upside. But that's going to be a key. That's going to be a key barrier on the upside. Downside, 8,000. I think we haven't really dipped below that for any length of time since we went above it earlier this year. So I think if we dip below that, that will be a warning sign that perhaps we're going to be stuck in a very broad range for a very, very long time. Cable 124, 128. Euro dollar 103.50 is the key level on the downside, and on the upside, well, I don't know whether you want to elaborate on that, Michael, in terms of what I've already said.
I missed that slightly.
Oh, did you? No, I was just saying the key support on euro dollars around 103.50, cables 124, 128. Where do you think is the key resistance on the euro dollar in terms of a rally through 106.20, perhaps?
Yeah, I'd probably put it slightly higher, maybe around about the 107 mark. I think that's probably what we want to get above before we start to have a little bit more conviction that the euro's bottomed out. Well,
I've got around about 106.20.30, which has been the high since the 13th of November.
Well, there we go. That's the first level to watch.
Yeah, that's the first level to watch. Okay, so that wraps up this particular review / whatever, and we will be doing another one of these. We're going to be covering the banks, the oil companies, and we'll probably do a little bit of retail as well. So thank you very much for listening. Happy New Year to all, and speak to you all next year.